Okay, thanks, Michael, for including our paper in the program. Okay, let me start. So this paper titled "Foreign Sentiment," joint work with Aziz Ben Rafal, Masu Masa, and Changying Zhou. Aziz and Changying are also in the audience. Okay, so. First, the paper starts from the start of this the role of foreign investors in financial market. There is a growing role, growing global market integration happening in the financial markets. This increased the role played by foreign investors a lot across borders. So far, the evidence has been that foreign investors exert largely a positive effect on local markets in terms of higher liquidity, better information environment, and higher information efficiency. However, the underlying assumption of all those studies and evidence has always been that international flows are originated by the rational investors. Surprisingly, they don't talk about the cross-border sentiment-driven actions of foreign investors. So this gives the motivation for our paper because domestic evidence actually suggests that sentiment is the first-order important effect in investor behavior and asset pricing. There are many seminal papers about that, like it can be dated back to as far as Keynes' Animal Spirits in 1936. At the aggregate market level, there's always also evidence that local investor sentiment resulting overreaction and the return reversal in the domestic U.S. market. So it is therefore very natural to conjecture that cross-border portfolio decisions via flows may also be subjected to investor sentiment and affect international asset pricing at the aggregate market level. Separately, domestic evidence also suggests that the sentiment can arise from interpretation of news or information, but it's not clear how public news or information will drive foreign sentiment because there's one special study in the international markets because given the international information barriers and the cultural differences, foreign sentiment may be particularly driven by destination market news instead of origin market news. Destination market means that it's the destination market of foreign investors' investment. Okay, this is like a hypothesis proposed by Dumas, Lewis, and also Benham, IFS paper 2017. So given those motivations, we ask two questions in this paper. Do foreign investors' sentiment affect destination market prices through cross-border portfolio flows? And if there is such foreign sentiment, does it arise from foreign investors' overreaction to destination market news? These questions are timely and important because recently, if you guys pay attention to a lot of academic conference, people are talking about that flows maybe have a very dominant effect in driving aggregate market price fluctuations. This paper by Gabas Kodian is being talked by a lot of people recently. I also have a paper showing that a recent paper showing that flows actually have very dominant effect on alarming returns. And Miana Kodian has a paper on the flow effect too, which is on individual stock returns. So this is like a hotly debated, totally discussed topic regarding the effect of flows on asset pricing. Our question is also important because it has important policy implications. Because if investors misreact to foreign news, then it will negatively affect the market efficiency and the global capital allocative efficiency. Okay, and those answers to our questions are not obvious because among many things, prior evidence suggests that aggregate flows kind of suggest that foreign investors play a positive role in financial markets. Okay, so the key challenges for us is how to identify sentiment-driven shocks that arise from foreign investors toward the destination markets, which are different from local or global sentiment-driven demand shocks. So our way of tackling this issue is that we use a novel data, a unique data on mutual fund investors' portfolio reallocation decisions. We call it flow shifts between destination markets and origin markets. So the data, our main measure is based on the ICI intra-family exchanges of U.S. investors' pre-existing investments in foreign and home markets. So the uniqueness of that is that if you invest in international market, that automatically implies you will divest from the U.S. market. So the flow shifts will reveal excessive relative interest of the original market investor, which is U.S. market investor, toward the destination market. So this kind of feature is something that total net flows cannot reveal, because this is like excess demand. Okay, and then also secondly, total net flows will be affected by investor long-term saving decisions and trends in their amount interjected into pension and asset management. It often does not reflect the explicit changes in investor sentiment. Our measure can reflect that. So the central distinction of our measure, in conclusion, is that it is an explicit relative shift in cross-border sentiment of foreign investors toward the destination market of investment. Okay, because I don't have all the time to discuss the entire paper, so I will just mention the main results. First, we first documented this foreign sentiment effect. Foreign sentiment predicts large reversals in destination market returns once the individual increase in this FS foreign sentiment measure is associated with a reversal of return of 1% per month and 3% in the next 12 months, with strong out-of-sample predictability that can go with Oscar that can go up to 4%. Okay, and we also identified causal evidence that foreign investors indeed exert such large foreign sentiment effect. We have two approaches. One is based on this. One central approach is based on this terrorist attacks plus this granular instrument approach, in which we verify and confirm that there's a very large effect of this foreign sentiment. 1% increase in foreign sentiment leads to at least 5% or more change in aggregate non-US market developed market returns. Such multiplier effect is quite large, especially if you think about this flow shifts is only 1/7 of the total cross-border flows. And this effect also have strong implications for the variance of international market returns. Okay, we also use some tax reform to have a further identification to shock U.S. investors' investment influence in foreign markets. We also find our effect is driven by U.S. investors, which is foreign investors. Okay, and then our second set of results is that we find this foreign sentiment effect is driven by news. So we first show that this foreign sentiment effect is primarily driven by overreaction to the local destination market bad news. Okay, and this overreaction to bad news will become stronger if the country is perceived more foreign by U.S. investors. So this is related to a behavioral bias called attribution bias or out-of-group negativity. Basically, you are thinking about other people as more bad than they really are. Okay, and then this, and we also use some attention shocks to increase U.S. investors' attention to foreign news, or decrease their attention to the news. And we find that this attention will actually increase. This news-driven foreign sentiment effect will be positively related to that attention to news. Okay, supporting the news is the underlying driver of this foreign news-driven foreign sentiment is underlying driver of this foreign sentiment effect. We also have some complementary tests. First is that we also show non-US investors also have a foreign sentiment towards the US market. They also overreact to the US bad news. Okay, and then lastly, we show that the capital flows, international capital flows, can be decomposed into two important components. One is the noise component related to foreign sentiment. The other is the traditional informative component documented by the earlier studies. Okay, so our punchline is that there's a worldwide sentiment of overreaction to each other's news. So everyone else is bad. So that's the punchline. So this is consistent with the recent paper by Dumas, the spirit in the recent paper by Dumas et al., which they argue investors are more likely to misreact to public signals in foreign markets than in their home markets. Okay, so our contribution are threefold. I don't have time to go through every one of them. So our central contribution is on international asset pricing. We establish foreign investor sentiment effects on cross-market asset pricing. So there's this paper by Exclusion actually show that in the domestic setting, there's a permanent impact of flows on domestic market price. They call it a demand-based non-informational effect. But in contrast, our paper showed there's the sentiment-driven part of flows generate transitory price fluctuations and return reversals across borders worldwide. But we link that to information, actually overreaction to information. So, and our paper also contributed to the news literature because we contributed to debate on whether news help, news and how news help interact with the generation of investor bias. Okay. So in the interest of time, I will go to the results. So I'll focus on the foreign sentiment of the US investors. The idea is that we have 4 sets of sentiment measures. We have US investor foreign sentiment towards the international market, international foreign sentiment towards the US market. We also have local sentiment of US investors, local sentiment of international investors towards their own home markets. So in the interest of time, I will not go over the details of how local sentiment is constructed, but basically the idea is that there are analogous flow measures that track local equity market sentiment of local investors. Okay. So first, our result indicates that U.S. foreign sentiment is linked to international market returns positively. So if you move money from U.S. to the international market return in the current period will also go up. This is also true for the local U.S. investors' sentiment towards U.S. equity market. That is, if U.S. investors are positive about U.S. local equity market, international return also go up. This is contemporaneous evidence. But if you go to subsequent returns, interesting pattern emerges. U.S. foreign sentiment predicts strong return reversals in international developed market returns, but local local U.S. investor sentiment towards local U.S. equity market has no effect on foreign market return reversals. Okay, and then the local sentiment in the international markets, like European investors' sentiment towards their own equity markets, also predict their own market return reversals. So in other words, there are some independent asset pricing effect in U.S. investors' sentiment towards European markets and the European investors' sentiment towards their own markets. Okay, and then interestingly, if you look at the remaining part of the U.S. investor flow, which is we call it sales redemption, they are not flow shifts. And you will find that they are consistent with the informative argument, that is, they positively predict the future returns. Okay, that's our central return predictability finding. To establish the causal effect of that, this return effects are driven by U.S. investors of foreign investors. So we use these terrorist attacks in non-U.S. developed markets to shock U.S. investors' flow shifts. The idea is that terrorist attacks make people more pessimistic in unrelated domains, and then these terrorist attacks are extraneous and exogenous negative news. So they satisfy inclusion restriction, but they have little economic cost on the aggregate non-US market economy. So they also satisfy exclusion restriction. So beyond that, above that, we also use this Gabax-Kodjian methodology, the granular instrument approach, to further purge out any endogeneity concerns of this terrorist attack. The idea is that we use idiosyncratic shock of terrorist attack numbers to identify the large shocks in the non-US developed markets. This idiosyncratic shock can never be affected by the aggregate market omitted variable because it affects all the markets. But our shocks are idiosyncratic. Okay, so and we can see that the terrorist attacks indeed shocked U.S. investors' flow switching. So when there are terrorist attacks, U.S. investors will withdraw money from foreign markets back to home markets, and this withdrawal will be related positively to current period return, meaning that foreign market return goes down, and then in the subsequent periods there will be a strong reversal. So if you if you calculate the implication of this coefficient, that implies that a 1% decrease of U.S. investors' flows, like a flow switch, they will lead to at least 5% decrease in the contemporaneous international U.S. developed market returns, and 25% increase in the 12-month subsequent period. This is a huge multiplier effect. Okay, so that's our first finding. Somehow Okay. And then we go to the second set of findings. This foreign sentiment effect is driven by news. We find that using impulse response function test, we find that only the news will drive sentiment, but the sentiment is not. News will drive sentiment, but sentiment does not drive news. Okay, so that gives us some motivation that this foreign sentiment is driven by news. So we do a formal test to interact this news tone with our foreign sentiment measure in the regression, in the predictive regression. So we find that we have this reverse news tone measure. Basically, the higher the value of this reverse news tone means the news is more negative. So you can see that our result is driven by when news is very negative. If the news is positive, they don't have this kind of foreign sentiment effect. And then if you look at the local U.S. sentiment, when the public, for example, when the European news tone is very bad, European investors' local sentiment is not affected by the public news. Okay, so this news tone seems to be uniquely affecting U.S. investors' foreign sentiment. Okay, and then it has a very strong effect on the sentiment measure. You can see that almost entirely our foreign sentiment measure is driven by the negative news in the destination market. To further pin down this channel, we actually decompose the flow shifts into positive and negative. So you will find that actually the result is driven by when U.S. investor, this is the negative sentiment, which means that when a U.S. investor withdraw money from, for example, European markets, when the European market news are also bad, that is the moment our sentiment effect arises. Okay, so this bad news actually does not affect European investors' own local market sentiment. Okay, that is very that's a very strong big contrast. Okay, and then we also link that to this outgroup negativity kind of idea, that is this foreign bias, this foreign negativity bias is driven by how foreign this country is. So we have some measures of foreignness, many measures of foreignness of a country. We find that this effect is this negative return predictability is stronger when the country is perceived as more foreign by U.S. investors. Okay, and then we use some like attention shocks to further identify the news channel. That is, for example, we have U.S. Olympic news, Olympic games, which will shift investors' attention to the games, not to foreign fundamental news. And we find that when attention is reduced, foreign sentiment effect is also reduced. So, and then we also have some shocks to increase U.S. investor attention to foreign fundamental news. Then the foreign sentiment effect will become stronger. So that highlighting the effect of news on driving our foreign sentiment effect. So we also have some additional analysis.
2 minutes left.
Okay, so some additional analysis, which is we reverse the test from, like, now we focus on, for example, U.S. Foreign investors, like European investors, whether they have foreign sentiment towards the U.S. market, and then we do this. We construct a similar measure as our U.S. foreign sentiment measure. We find a very similar results in non-U.S. investors settings. That is, European investors also think more negatively about the U.S. bad news. When the U.S. have very bad news, they also withdraw money, and then this withdrawal is too excessive. It generates return reversals in the U.S. market. Okay, and then lastly, we decompose cross-border flows into two components by projecting cross-border flows on the foreign sentiment, and then we find that actually cross-border flows have two important asset pricing components. One predict the reversal, the other predict continuation. So the reversal part is the part that is new, that what we document, but we show this component is actually very important. Previously is ignored by existing research. So to conclude, we can construct a normal cross-border foreign sentiment measure and establish that it has large and broad asset pricing effects on destination market prices. This is due to overreaction to destination market news. And then we provide a causal evidence. Okay, so actually I'm 1 minute earlier. So
spot on time, or even 1 minute extra.
Okay.
As a gift to Petri, who is now going to give his discussion. So please, Petri, the screen is yours for.
Yes, thank you.
15 + 1 bonus minutes.
I'll leave the one for the audience discussion. There we're sharing. You're seeing my slides, Michal?
Yes, all good.
Thank you very much. And thanks for asking me to discuss this paper. I think I'm becoming a bit of a piece of furniture for this conference. I think this is the third time Michal is organizing the conference. This is also the third time I'm discussing here. So looking forward to next May again. Very interesting paper. There's tons of stuff here. I try to squeeze this in one nutshell real quick. The authors study foreign sentiment, which is measured by US investors reallocating between foreign and domestic mutual funds. And this is going to be reallocations within a fund family, not just withdrawing money, but withdrawing money from one fund and putting it in a fund, in another fund within the same family. And the authors argue that this might capture better the short-term shifts in allocation. And so if an American mutual fund investor is taking money out of a domestic fund and putting it in an international fund, that would be a positive foreign sentiment. Foreign sentiment predicts international returns, contemporaneous returns positively. So this is kind of a price impact story there. And then more importantly, I think, predicts negatively future returns. So there is a reversal after this. The sentiment runs out. This is especially true as an overreaction to negative news. So there's something negative happening internationally or in a foreign country or outside of the US. And then that's especially when the overreaction by American mutual fund investors happens. If you're worried about endogeneity, they have an IV using terrorist attacks. There's a bunch of results, lots of interesting cross-sectional variation in these effects. Paper is quite a package. It's 86 pages, 26 tables, only 3 figures. But as a person who's really slow reader, I still thought this was a really nice paper to read because it's not overly long. So kudos to the authors. Very, very nice paper. There's a couple of things I want to talk about a bit more in my 15+1 minutes. The first one deals with some of the cross-sectional mechanisms in more detail. So let's have a chain of thought. So there is a US investor changing his or her allocation, or US investors as a group changing their allocation from international funds towards domestic. So they're having a negative foreign sentiment in the language of the authors. This will result in low contemporaneous international returns, and this will be followed by a reversal over the next 1 to 12 months in terms of high future international returns. Now, in the cross section, it seems that the reversal is stronger for Finland than it is for UK. And then we want to ask why. And the explanation of where this result comes from is that Finland is more culturally distant to the US than UK is. And I can definitely attest to that. Having been a Finnish person for quite some time and having many times introduced myself as a Finnish person to Americans, the response to learning that someone is from Finland is very varied. It varies from the praises to the social democratic Nordic welfare state to questions like, is Finland somewhere near Montana? And do you guys have cars? So Finland is a weird place for Americans, and I agree that Finland is culturally more distant. But then what I don't quite get is how does this fact that people don't know where Finland is or if we have cars, how does this translate into the reversal being stronger in Finland than it is in UK? Is it because US investors are selling their Finnish stocks because they have some negative overall international sentiment or foreign sentiment, and then they go, damn, I don't even know where Finland is, I better sell my Finnish stocks? But then the question is, do these people own directly Finnish stocks? I think they don't. They own mutual funds and they redeem from the mutual funds. So do they redeem from mutual funds that hold more Finnish stocks? Is there cross-sectional variation in country holdings of these funds? And do they, in these times of negative foreign sentiment, do they redeem more from funds that hold more foreign? Or more from funds that hold foreign stocks, but more in these like culturally distant, more foreign countries. Do we have any evidence on this? That would be kind of interesting. Or is it because the funds themselves choose to sell more Finnish stocks than UK stocks when the fund managers see that, oh no, my investors are having a negative foreign sentiment, I better make my fund look better to the Americans who don't even know where Finland is, so I better sell my Nokia shares and buy some Vodafone instead from the UK, so the reversal is going to be stronger in Finland. Does this, if that's the channel, does it help with flows? Or maybe this mechanism works through some other channel. What is that channel? How does it work? Just it might be nice to help the reader to understand this particular mechanism a bit better. I mean, on the first read, I kind of got it. Yeah, it makes sense that culturally more distant thing has a stronger reversal. But then thinking a bit more, I sort of got myself stuck of not really understanding it anymore. Then the second thing I want to spend a bit of time on are these predictive regressions. So this is like the, this is where the money is in the paper, right? So we find that the foreign sentiment predicts international returns. So we run this regression returns on a, country fixed effects plus beta times the foreign sentiment plus a bunch of control variables, and that's it. We have returns from 4 countries. So this is a panel. Let me have a pointer here. So this is a panel, returns for country C over months from T+1 to T+K, where K is 1, 3, 6, 9, or 12. So we're looking both at the 1 month returns, but then also the longer horizon returns. And then it's important to note that the foreign sentiment is a macro level variable. So it's the same for all countries at time T. So there is no Finnish sentiment and UK sentiment, there's just foreign sentiment. So these might in a panel setting cause a bit of a trouble, but the standard errors are clustered by time. So that's taking care of that. That's totally fine. But what I have a bit of an issue maybe with is that we're having overlapping returns. We're having a rather persistent predictor variable. So foreign sentiment has quite a strong autocorrelation, though it's not explicitly reported in the paper, but you can infer it from some results. And we have a panel structure. So the question I have is, are the standard errors that are clustered by time, are they robust to this particular autocorrelation and heteroscedasticity structure that the overlapping returns and persistent predictor are going to impose into the data? And the answer is that I have no clue whether they are robust or not. So I ran a small simulation study. I took the same return data as the paper uses. So MSCI country indices for 92 to 2017. These are supposed to be exactly the same. I don't have the foreign sentiment data, so I simulate a pseudo foreign sentiment. This is totally random, but it follows an AR3 process. So there is a VAR model presented in appendix table 4, from which I'm kind of able to tease out the potential AR parameters of the foreign sentiment. Now I have to admit that those might be quite wrong, but I'm using the ones I have. And then I just run it with my simulated data or actual returns, simulated foreign sentiment, running this same regression for different time horizons, clustering standard errors by time, repeating this exercise 10,000 times and collecting the p-values of the beta coefficients. And here's what we get for 1 month returns. So if the test is perfect in every way and everything is random, we should have p-values being uniformly distributed between 0 and 1. And I'm just plotting the relative frequency here of p-values going from 0 to 1. So we can see that overall they are more or less uniformly distributed. There's a bit of clustering or a bit of more frequency here in the low p-values. So we have 6.3% of the simulations being statistically significant at 5% level and 1.5% being significant at 1% level. These are, of course, supposed to be 5 and 1. But so there's a bit of over rejection, but given that it's there's all kinds of things going. I don't think these are terrible. These are totally acceptable levels. Also, the significance in the results in the paper is super high. So these are not worrisome numbers per se. But then when we start adding this overlap into the return, so we go to 3 month, 6, 9, and finally let's look at the 12-month returns. So I'm now getting, with my totally random pseudo foreign sentiment, 20% of my simulations are showing up to be significant at 5% level and 10% at 1% level. So I'm getting a massive amount of overrejection. Now, I can't really compare this to the results in the paper because the results are so significant that a lot of times they're 2 decimal p-values are 0.00. So I don't know how many zeros you could add and before you get some non-zero digits in the paper. But this kind of seems that there is a problem with overlapping returns in panel with persistent predictor. So we have these this triangle where we have the overlap, panel structure, and persistence in predictor, and those 3 coming together. So my kind of conjecture is that those 3 coming together create this problem. So potential fixes would be just remove one of those sides of the triangle and life would be good again. You could remove the overlap. Just look at, if you look at monthly data, then you cannot do the long-term return, so that doesn't really work. You could look at annual returns with an annual data, but since there are not that many years in the data, so it's fairly short, only starting in 1992, so I think that's just going to result in low number of observation, low power. So removing the overlap is not really going to be the answer, I think. Removing the panel structure might be an idea, so do a time series regression rather than the individual country indices. Let's take the MSCI World index and regress that on foreign sentiment. This is already done in the auto sample test and it shows statistical significance there. So I think it should show statistical significance also in the in-sample predictabilities. And there, of course, we need to adjust the standard errors a la Hodrick 92 or something else to account for the overlap. But this then falls apart when you want to look at those really interesting cross-sectional effects, because you can't do cross-sectional effects in time series. We could remove the persistence, look at shocks to foreign sentiment rather than foreign sentiment itself. This is also done already in the out-of-sample test, so it would be easy maybe to do also in the in-sample test. And I tried it in my simulation, so I took shocks to my pseudo-foreign sentiment rather than pseudo-foreign sentiment itself. I'm looking at 12-month returns. Distribution of p-values is perfect, I would say. That gets rid of the problem. Just remove the persistence from the sentiment and that kills it. I don't know if the economic interpretation of the results is going to be affected by this. I'm not sure. I don't know, but this seems like a reasonable avenue to take. Or then one can adjust the standard errors, so clustering by time to account for the fact that FS is the same for all countries, and then somehow heteroscedasticity and autocorrelation consistent in time series. I don't know how to do that. Quick Googling didn't seem to give me anything, so I think that could be quite tricky, but I don't know. So something maybe needs to be done to address this issue. And then I have a bunch of small issues. Michal, how much time do I have? 2 minutes?
2 minutes, yes.
Okay, so I'll take 3 first ones. So currently the stuff is done using US dollar returns of these foreign countries. You could also try to just repeat that for local currency, just to confirm that results are not driven by FX changes. The reversal doesn't seem to slow down after 12 months. It would be interesting to see what happens after 12 months, but just I'm saying this right after I said that there's problem with overlapping returns. So given that you find there's a fix for the overlap, it might be interesting to at least take a peek at what happens at 24 months. Then the rest is just tiny details and maybe typos in the paper. So I'm just going to jump to my summary. Very interesting paper. Tons of interesting results, very cool merger of previous research agendas of the authors. I really like this paper. Some fine tuning to spell out the exact mechanisms the authors have in mind, and then think about the inference in predictive panel regressions. And I'm looking forward to you publishing this in a good journal. Thank you.
Thank you very much, Petri. So after this discussion, I think it's pretty clear why we keep inviting you to discuss. Xi, would you like to take a minute to respond to any of the comments?
Yeah. So thanks, Patrick, for the insightful discussion. So all the points are well taken. So I just want to mention two things. So so your first comment about Finland is actually as a very useful comment. So actually, we have been thinking about this. So when the Finland is a more foreign country than UK, so when US investors withdraw money from the international funds in general, how can Finland stock price drops more? So one possible explanation is that our measure is a flow-based measure. So it's a proxy of the general foreign sentiment of US investors. So the price change is more affected by the sentiment itself, not about the flows. So in other words, when investors withdraw money from the non-US market, the sentiment in Finland market is even more bad than the US market, than the UK market. So that's why the price in Finland market drops even more. For example, like it could be like just as you said, it could be the fund managers who sell the stocks across the board, the UK stocks and the Finland stocks. They sell all of them, but they are willing to accept a lower price in Finland stocks because they just think more badly about Finland market. I'm sorry, but yeah. So that's a one potential channel. But we definitely can look into more exact, like a direct evidence of that. So it's more about the sentiment itself, like more like opinions rather than the flows. So and then for the panel regression, currently we tried some like clustering by country, a double clustering kind of thing. It's kind of addressed a little bit this like to some degree this persistence effect in the dependent variable, but we could definitely try the things you suggested, like some like shocks to foreign sentiment and other things. And all other points are very well taken. We will try to look into that after like I will ask you like after the seminar, after the conference, I will ask you for the slides. But thanks for all the comments.